Okay, chapter 16, the investments video. This is talking about options valuations. I think a little bit about derivative markets as well. So intrinsic value of an option. The intrinsic value is the stock price minus the exercise price or the pocket or profit that could be obtained by immediate exercise of the in-the-money call option. So if it's in the money, which means it is, exercising the call. So calling the stock would actually earn you money right now. That's what we mean by in the money. If it's not in the money, then the intrinsic value is zero. If it's either out of the money or at the money option, then this intrinsic value would be zero. But if it is in the money, then the intrinsic value has some value to it because it's effectively what you would earn by exercising the call option immediately. The time value is the difference between the option price and the intrinsic value. So, if I exercise it right now, I would earn, say, $10, whatever it is. But the option price, if it's higher than that, say it's $12, $15, whatever it is, that's the amount of the time value. Effectively meaning, why we say time value here is because holding on to it for a given amount of time is supposed to make you more money if you don't exercise the call option right now. So how do we determine the value of an option? There's 6 things that determine the option value: the stock price, the exercise price, the volatility of the price, the time to the expiration, and the interest rate and the dividend rate. That all are parts of how we come up with a value and end up to a value for whatever call options we're mainly talking about right now. So this here, the option value is on the vertical axis. Okay, so we got X here in the money. So if we're over in this direction, then there's some intrinsic value. If we're over here, or if we're on the line or in this direction, there's no intrinsic value. And then the difference between my value of my call option and notice that by the way, when we're out of the money, this gray line, you can't really see it on here, but effectively really this gray line is right on the horizontal axis from this point all the way up to the exercise price. Once we reach past the exercise price, once we basically have some value to the call option immediately, that's when you see it start to slope up. And the difference between the value of the call option and the intrinsic value is the time value, which we just talked about in the prior slide. So variables that increase and what that does to the call option. If the stock price increases, the value of the call option increases. If the exercise price increases, the value of the call option decreases. If the volatility increases, the value of the call option increases. The time to expiration, if it increases, then we increase the value of the call option. The interest rate, if the interest rate increases, it increases the value of the call option. And if dividend payouts increase, it decreases the value of the call option. Okay, so the two-state option pricing. If we assume a stock price can only take on one of 2 values, so we're doing this kind of as a binomial, what they call it, a binomial option pricing. So the example here says, suppose that a stock sells at $100 and the price will either increase by a factor of U, that's up 1.2, which would be $120, or fall by a factor of D for down of 0.9, which is the bottom value here. So the 1.2 is how far it could go up, and D is the 0.9 on how far we think it could go down by the end of the year. The call option on the stock might specify the exercise price of 110 at the time of expiration of 1 year. The interest rate is 10% at year end. The payoff of the call will either be 0, or if the stock falls, or $10 if the stock price increases. So this is the value. So if it ends up increasing, it's $10. If it ends up decreasing, the value is going to be 0. Okay, the two-state option pricing. Compare the payoff of 1 share of stock by borrowing 81.82 at 10% interest. So we got 1 stock and borrowing of 81.82 at a 10% interest rate. The payoff of this portfolio depends on the stock price at the year end. we know that the cash outlay to establish the portfolio is $18.18, $100 for the stock less the $81.82 of proceeds from the borrowing. So they end up, actual money out of pocket. You borrowed $81.82, and the cash out of pocket, this $18.18 comes from the difference between the $100 price and the $81.82 that you borrowed for this option. So outlay is only $18.18, which means that the payoff is 3 times the call option. A 2-state option pricing, a portfolio of 1 share and 3 call options is perfectly hedged. So we've got this example is a portfolio made up of 1 share of stock and 3 call options. Its year-end value is independent of the ultimate stock price. So so that basically means that we're gonna make our net payoff one way or the other. So that's what we talk about. We're talking about hedge. It's kind of like if you ever heard the phrase hedging your bet. It's effectively weighing your investment options in a way that you're not going to lose out. In this case, that required buying 1 share of stock and then having 3 call options on stock as well. And this is the hedge ratio here. Okay, generalizing the two-state approach. If we break up the year into 2 intervals, and then you can actually subdivide even further than that. So this would kind of be our initial one that we did, call up and call down. And then we're separating, so we've got time. These are effectively 2 time intervals, and it could be, whatever time interval you set them at. Could be 6 months, could be 3 months, whatever the time frame is. If you're splitting it equally, and we're talking about our portfolios we're just talking about, it's a year, then this first option would generally be 6 months, and the second option would be the second 6 months. But notice what it also does, where our first binomial approach only has the 2 options. Now we've really got 3 options, because even if in the first 6 months it goes up, it could go up again, or it could go down again to basically be the same as what it was to begin with, or it could go down twice. So we got three options here once we break it in. And then you can actually go even further with that. So you could actually start doing this. So you could do this monthly. You could really, if you wanted to do this daily, you could do it as often and frequently as you wanted to. But the more you do it, the more you have the chance of potentially hedging. And also, once you start making a tree like this, you realize your decision moves down the line. So if you say this is, so we got 1, 2, 3. So let's say this is another year still. So let's say this is every 4 months, just to make it an even year. So after 4 months, let's say I'm here, I realize my options could either go down still, or it could go up twice. If I decide to keep it and it goes down, now I know my next option is either going to go up or down. But every time one of my time frames, expires, then I have a decision to make, knowing that I've got these different options and these different patterns of directions that it can go. So this is the probability distribution for the final stock price in the 3 sub intervals that we just talked about. So the 3 sub intervals that we had as far as options go. This is the final stock price is on my horizontal axis, and the probability of it occurring is on my vertical axis. So if there's 6 subintervals, notice it starts to flatten out even more. And the more intervals we put in there, guess what's going to happen? So what is that? I mean, if you all know what a bell curve looks like, we know what a probability curve looks like. Effectively, the more subintervals we put in, so we get from 3 to 6, it looks more and more like a bell. And then when we go from 6 to 20, now it looks a lot like a bell curve, which makes sense. I mean, if it's a statistically accurate model, then we should be able to eventually, with the more subintervals we put in, effectively in subintervals we're really talking about, it really adds an additional data point. And the more data points we add along this line, and you can see the little breaks where you got 1, 2, 3, 4, I'm not going to count them all, but 5, 6, 7, 8, 9. So there's a total of 20 of those little breaks in the line. If I made this continuous, then it would end up obviously being a bell-shaped curve. Okay, while the binomial model is flexible, it requires usually a computer to be useful in actual training. An option pricing formula that's easier to use than the algorithm involved in the binomial model turns out that such a formula can be derived if one is willing to make two or more assumptions. One is that both a risk-free rate and stock price volatility are constant over the life option. In this case, as the time expiration is divided at even more subperiods, distribution of that stock price at expiration progressively approaches the log normal distribution, as we just saw in the figure that we just looked at. This is the Black-Scholes formula, brought up by an option pricing model by Black and Scholes from an article in 1973, and another one from Merton in 1973, which has a formula for the call option. Now, what these symbols mean: CO is the current call option value, SO is the current stock price, S0, excuse me, C0 and S0. ND is the probability that a random draw from a standard normal distribution will be less than D. X is the exercise price. Sub E here is the base of the natural log function, approximately 2.718. In Excel, we can look this for the function exp is the function that we use for that. This, which I can only describe as I believe it's I know it's a Greek symbol, but I always think of it as a section code for legal stuff. But this emblem here is the annual dividend yield, or the underlying stock. We assume for simplicity that stock pays a continuous income flow rather than discrete periodic payments like quarterly dividends. R is my risk-free rate. T is the time remaining until the expiration of the option years. And then LN, and it says, well, we're D1 and D2. LN is a natural logarithm. In Excel, this is an LN function, quite literally A equals LN, and it can be calculated using this function in Excel. And then we have our standard deviation, or in this case, our standard deviation squared, but this is our standard deviation, the annualized continuously compounded rate of return of the stock expressed as a decimal, not a percentage. So this is what I just went through the whole thing. Okay, so this is the standard normal probability function. And like I said, the more intervals we put in, like we did with this Black-Scholes model, the more it becomes just a bell-shaped curve. The Black-Scholes pricing model has implied volatility. The standard deviation of stock returns is consistent with the options market value. Okay, so this is a Black-Scholes call option value. I'd recommend building this. It's really pretty easy to build. These blue cells here are numbers that you actually put in, expiration, risk-free rate, return, all those things, exercise price, stock price. And then this is the function that you would put in these E cells. So this is a formula output in column E. So I would put these formulas in Excel into these cells, and I did go do that to make sure. I had a little bit of a rounding error, but very, very minimal overall, where you know, this came out to 6.99 rather than 7.00. But outside of that, you can see that the functions, I did exactly the function that they typed, or just type word for, or letter for letter. The function separate has to have an equals in front of it or plus sign to be an actual function. But other than that, I put just exactly what they put in their cells in the book, and I just built this myself. It's not something the book had, but to get the same results as what we had here. So now we've got the value of our call and what the value of our put value is for both, for this particular stock, for this optional stock, I should say, for this call option. Another thing we can do, and this one I showed, I think, in a different video, but I can't remember for sure, so is a goal seek function. So if you've never used this in Excel, a goal seek function is done, and you have to add this to your Excel if you don't have it. If you don't have it, I'll show you that really quick. It shouldn't take but a second here. If you go over to Excel and you go to options and you go to add-ins, you want to make sure and put your analysis tool pack in, and I already have mine in, so I'm not going to add it again. But you click on that and you push OK and make sure that you add in the analysis tool pack. And if you do that, you can use this what if analysis and find goal seek. So if we want to set cell E6 to value of 7 by changing cell B2, we hit OK. Not really gonna do anything because we already have it. So let's put this at, let's delete this for now. So if I want to do, it should work, goal seek, I'm gonna set cell B6 to value 7 by changing cell B2, hit OK. Let's see here. Okay, sorry about that. I'll rerun this goal seek. I didn't realize with goal seek that you had to have some kind of number in the standard deviation. I had it just as nothing, and it wouldn't work for that. So just put whatever number you want in here. It doesn't really matter what the number is. I'm going to put 0.1 in there. And I go over my what if analysis and I go to goal seek. And I want to set my E6 value to the value of 7.0. And I want to change cell B2 in order to do that. So what this is going to do effectively is the computer is just going to run a whole bunch of scenarios. It's going to change B2. In your settings, you can change how much it changes it by, how many decimal points you want to go to. But it'll change cell B2 until this E6 equals 7.0. So you see it did that, and you see it came up with basically, obviously a little more extended decimal, but basically the same answer as what the book had in the first place. Okay. So this is the implied volatility of the S&P 500. So the percent is on the vertical axis, and the years from 1990 to 2017 are on the horizontal axis. The large peaks are labeled for the Gulf War. We had 9/11, we had Iraq, we had the financial crisis, all these things, and the U.S. debt downgrade that happened in 2012 or so. Okay, put call parity relationship. This represents the relationship between a put and call price. So in this case, we're talking about the fact that we have a call and a put, and the extension for the European call options and dividend paying stocks looks like this. So the payoff for a long call is 0 until point X. So this is a long call, so its payoff is 0 until point X. And then obviously the payoff goes up quite a bit. The payoff for a short put is negative until point X. And the reason for that is because I put money already into it until it reaches line X. And then the leveraged equity is negative until point X and then positive thereafter. So effectively, leveraged equity, we're talking about having both puts and calls. Leveraging could also be, also kind of a version of hedging, where I've got a combination of these two that continues in the upright. Basically combines the beginning of this payoff and the end payoff here into one single line for the leverage equity. Okay, arbitrage strategy. So arbitrage basically is owning assets, usually owning both puts and calls on the same assets, so we can take advantage of price movements no matter which direction it goes. So it's kind of that leveraged equity, or kind of that hedging that we've been talking about. So we talk about the difference in position. So if we buy stock, just what it looks like in the first place, the cash flow in the first 6 months, if it gets to be 105. So we got immediate negative cash flow 110, and then obviously our stock differential would be what our cash flow in 6 months would be if we choose to sell the stock. If we borrow the stock or borrow the cash instead to buy it, then we could have a negative cash flow in 6 months if it is greater than 105 or greater than or equal to 105. If we have a sell call, we could bring money in. If we sell a call, we're bringing $14 in to sell that call, cash flow is 0, and then we have the negative, the stock price minus 105. If we buy a put, we got $5 going out, and it's 105 minus the stock transaction, the stock price. So you can see that our immediate cash flow, we have a total of 1.41. And then notice also, if I'm buying a combination of all these, so if I buy stock, if I borrow, if I sell a call, and I buy a put, do all those in one, effectively I've zeroed out whether or not I've hedged, I've leveraged, so that whether it's greater than 105 or less than or equal to 105, I end up with a zero difference in cash flow in the end by buying, and I'd have to buy equal amounts, obviously, of each of these. All right, the Black-Scholes formula for the European options. Just a little bit different. Remember, European option, the difference between this formula and the other formula, the main one is the fact that in the American, remember, to go back to prior chapter, in American options like this, you can buy or sell from the point of purchase up until the exercise date, whereas in European, you have to buy or sell on the exercise date itself. All right, hedge ratios in the Black-Scholes formula. The hedge ratio, or delta, the number of shares required to hedge the price risk of holding one option. So what do I need to buy so that I do have that zero risk formula that we just showed in that about 2 or 3 slides ago? An option elasticity. So percentage increase in the option value given a 1% increase in the underlying value of the security. So kind of like in economics, we talk about elasticity. We're talking about the reaction to another price change. So the elasticity of an option is how much it increases for every 1% of increasing of the underlying security. So if my underlying security goes from 100 to 101, that's 1% difference. What is the change in my option price at that point? And actually, I guess I should say the elasticity itself is the percentage change. It's the relationship for 1% change in the value. What's the percentage change in the actual option itself? All right, value of a call. Okay. So the value of a call, and we got that on the vertical axis, and S sub 0 is on the horizontal axis. The line of the horizontal and then curves upward. The line is horizontal and curves upward. So S sub 0 equals 120, and the slope of the line equals 0.6. All right, portfolio insurance. Portfolio strategies limit investment losses while maintaining upside potential. So that's what the hedging and the leveraging will do, is it can, by buying call options and even put options too, you can make it so that you possibly don't have either very little or not much downside while still having a potential upside. Dynamic hedging, constant updating of a hedge position as the market conditions change. So where I'm buying and selling call options all the time to make sure that I'm staying continuously hedged, so that I am, protecting myself generally. Generally, I'm protecting myself against losing money. Okay, so the change in value from a protected position. So that's on my vertical axis, the change in value in the underlying asset. And the difference between those two at value P, negative P here, is the cost of the put. So protective, this is on put strategy rather than a call strategy that we were talking about for most of the chapter. So the value of a put, we've got over here on the vertical axis, and S sub 0 is on the horizontal axis. The line slopes down and then curves as it approaches the horizontal axis. A higher slope equals a higher hedge ratio, and a lower slope equals a lower hedge ratio. So we've got the highest hedge ratio here and a lower hedge ratio down here. So as it approaches, I don't need to do as much hedging as it approaches S sub 0. Okay, option pricing in 2008, 2009. When banks buy debt with limited liability, they implicitly write a put option to the borrower. So effectively what it's saying is, when a bank buys debt from someone, so they're buying, say, a loan, so you've given someone a loan and they're buying that from you, but they're limiting their liability, which means if that debt goes bad, if that debt goes unpaid for some reason, the bank is not necessarily responsible in this case, and this would be from a legal term or legal perspective, we'd be talking about this would be with recourse. The bank would have this contract with recourse, which means that if it did fail to pay, then they could, basically get the bad debt back or sell the bad debt back to the company that they bought the debt from in the first place. So there's not very much risk being taken on by the banks themselves in this situation. So you got the payoff on the vertical axis, and we've got the face value, which is L, until the value of the borrowing reaches the price of L. And then once at that point, any greater value from the payoff is in L dollars. In general, the value of L dollars minus the payoff is the implicit put option, implicit value of the put option. Okay, value is a percentage of face value of debt. And then with our vertical axis, the firm value as a percentage of the face value of debt is our horizontal axis. So the value of the put as a percent of face value of debt is on this vertical axis. The concave curve up, curve slopes from 50 to 45 and 0 to 225. So we got from here and 50 to 225 is the two unlabeled tangents are shown, and these values are approximate. Okay, implied volatility is a function of the option of moneyness, that is the ratio of exercise price to the assets. So you'll notice that we have the implied volatility and the ratio of price to current value of index on our two axes. March 2009 slopes down in a concave up manner from 0.7 to 70. So from 0.7 to 70 here. Through 1.1 to 45, and then you notice it starts to trend up there. In April 09, 10% less is roughly parallel values, is roughly the parallel to the values. And that's it for chapter 16.